All right, folks, we are just getting started. Hold on for 1 second because I was about to get a echo here. So let me just mute something really quick. All right, perfect. All right, just want to double check here. Can everybody hear me okay? Looks like you can. All right. All right, so I'm just readjusting my screen here so I can see all the chat. All right, looks like it's frozen a little bit on my end, but I think you guys are good. Oops. There we go. All right, perfect. Okay, so before we get started, I need to ask you guys to do me a huge, big favor, and that is to like the video. I need you to like this video, please. So hit the like button. Also, go ahead and subscribe to our channel while you're at it. All right. So I just want to make sure we see some likes coming in. I'm looking right now. Still waiting to see some likes. Got to get some likes in here. Please be sure to like the video please, before we get started here, guys. Greatly helps us. Hey, Scott. Maybe mine's not keeping up, but let's see. Let's get some more likes, guys. Some more likes. All right. I'm going to get going here because I don't want to keep everybody waiting too long. All right. So let's just jump forwards here. So, again, my name is Mike Patton. I am the prop trading coach over at Funder Trading. And you are here live for Market Minds, which we like to do. This is your opportunity to see some of the thoughts and some of the observations and some strategies that we use here in the market. So, really thankful for everyone to join us today and looking forward to telling you a little bit more about what's going on in the market. So, let's jump right into the markets. But let me give you a little bit of background about myself before I jump into that. So, I started my career as a commodities trader. Sorry, I think this is not showing my full screen. 1 second. Let me go back one slide. There you go. Sorry. So I started my career as a commodities broker in 2005, identifying opportunities and executing trades on behalf of clients in the futures markets. Mostly we're doing futures options. The first trade ever was in unleaded gasoline options. If any of you have ever traded that, it's pretty interesting. I'm also the former head of day trading education at Prosper Trading Academy. I focus on both stocks and stock options. Also, I was a proprietary trader at Global Prime Trader and Great Point Capital. Great Point Capital was the longer duration. Global Prime, I started after that. Both of those companies were focused on day trading of equities. Started there in 2014, if I remember correctly. Yeah, it was 2014, late 2014 at Great Point Capital. And I ended my time at Great Point Capital in 2019, if I remember correctly. So now, currently, I'm overseeing a group of proprietary traders every day. So we're trading the markets every day, including today. And that's what we're going to talk about. So the markets are under pressure, like that Freddie Mercury song, under pressure. Okay. We are seeing a lot of pressure in the markets to the downside, and you probably have noticed it. Now, why is that happening, you might ask? The reasons are varied. There's lots of different reasons why the markets are under pressure. Let me just go over a few of the ones that might be of interest to you guys. So, for one thing, we're seeing some rotation, some sector rotation. The recent slide in tech-heavy indices reflects rotation into defensives, not a broader downturn. Okay, so according to Citigroup, this is a natural cool down after a strong rally. And let's face it, we've had some pretty strong rallies in the tech sector. Meaningful pullbacks need a catalyst like policy shifts and or stock earnings to be able to move. Okay. Now, what traders should do, As an investor or as a trader, the first thing is don't panic. Okay. A lot of times when people see the markets take a turn to the negative direction, they freak out. They say, what should I do? What should I do? Right. Well, the reality is that you don't have to worry about downturns and upturns if you're a trader in the ultimate sense, because a trader can make money in both directions of the market, first of all. Like, for example, today we were looking at opportunities for stocks going down just like we were yesterday. So the reality is you can make money in both directions. Volatility is always a good thing for traders. You want markets to move in order to make money. Now, as an investor, it's a little scarier because you just want things to go up in a straight line, right? That's understandable. But obviously, as a trader, you have to think more about the ups and downs and trying to exploit them. So if you're an investor, usually the best time to buy is when the markets are sharply down. That is a fact. Does it make a huge difference in the long term? It can. In other words, if you bought your stocks when the markets were down in 2009, at the near the bottom of the run, if you did that at the bottom, near the bottom of 2020, during the sell-off from the coronavirus, or if you did it during the sell-off that we saw on Liberation Day when President Trump announced, the Trump administration announced tariffs, and every one of those situations, right? What happened shortly after? You had the market recover, right? 2009 took a long time to recover, but 2020 was faster. And of course, the tariff recovery was vastly faster. So I'm not saying that every time the market goes down, it has to go back up. That's not true. But as long as the US economy is still going to exist, as long as companies are still going to exist and grow, then basically over time, you should expect equity markets to go up as long as there is economic growth. And even if the economic growth might be slower for a while, as long as in the long term it's expected to grow, then you still have a bullish case for investing. Now, let's talk about a few other things. Walmart had some disappointing earnings. Walmart's earnings, they beat top line estimates and raised full year guidance, yet earnings were a miss. So shares dropped about 3 to 4%. That pushed the S&P 500 down. The Nasdaq usually follows suit. So that's actually putting some pressure on the downtrend. Now, retail sectors are actually something that we do want to pay attention to, because the amount of money people spend is something that gives us a sense of the health of the economy. So if spending is really going down, that does imply that things are slowing down for an economy or stagnating. Doesn't mean they're getting bad, just means that maybe things are not getting much better, right? Now, we do also have to factor in the Fed. Okay, we have Chairman Powell is going to be making some comments tomorrow, and we had the Fed minutes that came out on Wednesday. Now, the bottom line is this: everyone's looking for a rate cut. I mean, it's true. The markets want it. The administration, the government wants it. The Trump administration wants it. But the reality is that the Fed, for the most part, is going to have to decide when they want to do that. And if they decide not to lower, which is what everybody's expecting, that we're going to get a rate cut sometime in this, in the next meeting or the next decision, which should be in September, they're expecting a cut. But let's suppose we don't get one. If we don't, that's going to put some more pressure on the markets. Now, recently, as some of the other commentators have mentioned on Market Minds, we're seeing a diminishing of the probability. It's still a high probability that we're going to get a cut, but it's going down from like 90-something% into the 80s. So that means there is significant reason to suspect that maybe we won't get it. So that will put some downside pressure as well. But at the end of the day, it's just going to come down to what the decision is when we get there. So the markets, if they feel a little less certain, then they're going to trade a little less certain. Also, we should keep in mind that interest rates have a massive impact on tech stocks. They're usually the most affected by interest rates. So if you see an interest rate hike, which like we saw, basically, if we go back to post-COVID, when we saw the big sell-off in 2022, we had interest rates steadily climbing. That has a usually large effect on tech stocks. So just something you should know. All right. And then finally, we see futures. U.S. futures have been weak. Obviously, there's a lot of different uncertainties with tariffs, with changes in trade policy and things like that. So there's a lot of things that are affecting the markets as a whole. So we should expect some more volatility. But overall, what we're seeing in the markets right now is nothing, as far as the behavior, is nothing shocking. It's pretty much what we've seen in the past, and we'll probably see again in the future. All right. Now, having said that, let's jump forwards into some of the things I wanted to discuss. Now, I wanted to discuss some stocks, right, that have recently had some pretty sharp moves down. And I want to point out something about that. So these four stocks, Intel, Lyft, Nvidia, and Patton, and there are many more, have recently saw some really sharp moves down. But I wanted to show you some pictures here that I took of that. And I'll have to pull them up here, so bear with me one second. But I want to show you some pictures that will kind of illustrate what was happening. So first, I want to show you INTC, Intel. Of course, Intel's been under a lot of pressure. So here's a picture, a photo of what happened. I'm waiting for it to show up on the screen. There it is. Okay. So Intel, if you look on my screen, you can see that this was yesterday, right? And the stock opened right around here where I'm circling my mouse. All right. And then immediately it goes into a complete nosedive. Now, I drew a Fibonacci retracement, not because I'm using Fibonacci's, but I want to show you something. I put it as a 75%, meaning that where has the stock moved 75% from the opening price to that bottom gray line? I'll tell you what that bottom gray line is in a second. So once we got to about 23.97, Intel, INTC, had already come down 75% to that gray line. Now, that gray line is a target. Now, in the for the day traders that I work with who are proprietary traders, either in training or already funded, these people, I give them alerts and I let them know where my targets are for potential price movement for individual stocks. It could also be for ETFs as well. Now, I only can do that for stocks that are more popular. In other words, if it's a very obscure stock, I won't really have good data. But if it's a major stock like Intel, there's plenty of data. So I have an algorithm that I designed that basically crunches a bunch of data and then makes projections about where a stock might end up today at the maximum extension of its move if it gets on a good trend. So I'm looking for a stock that shows clear indication that wants to go up or down. It starts out the gate moving sharply up or down. This one started going down. And then that target basically is just saying, okay, this is as far as I can project. So think of it like when companies do their earnings reports, they say, hey, this is what we project our future earnings are going to be. This is what we project our future revenue is going to be. Even though it's not as complex as that, it's a similar idea. I'm just making a forward statement, a forward estimate of where something might be able to go if it continues on a strong path of momentum. So what I'm saying here is that at the beginning of every day, I have this information for whatever stock I need to look at. So I just share that information to the members. And I just say, okay, here's where we started, the opening price, and this is down to the bottom. If the stock's clearly going down, that's how far I project it might be able to go, 23.67 roughly, okay? And what's difficult, however, is when a stock falls this fast, these are 1 minute bars. So that's 1, 2, 3, 4 minutes. And 4 minutes flat, the stock has already hit 75% of the projected maximum range to the downside that I had calculated with the algorithm. Now, that means it's going to be tough to be able to make that trade because by the time I see it, which most likely will take a few minutes because you have all these stocks up on your screen, right? I keep it to a minimum, but even with 30 stocks that are there on my screen, and I have it sorted based upon how far the stock has moved up or down from the opening price, even with that, it's still not that easy to find the stock quickly. So now we knew INTC was under pressure anyway, so some of the people were expecting it to fall, and it did. So they may have caught it very early. But if I'm looking at it based on I'm trying to find a trade setup and trying to find an entry point to that, it fell too quickly. And this has been a problem that we've been facing over the last 2 days or so, that we've been having stocks that as soon as the market opens, they immediately go straight down, right? So it's not really any time to find out is either that stock was on your radar before the market opened, you already saw it at the open, you were on it right away, or you missed it. It's been pretty much that way. So this has not been the easiest time, right? It's not been the easiest time to be able to get into a trade early in the session, which is where most of the movement occurs. Just out of curiosity, have any of you been noticing that in your trading, that if you're intraday trading, that you're seeing massive movements happen very rapidly right at the start of the day, and by the time you see the stock, it's already been miles and miles away from the opening price? Anybody noticing that recently? Yes, copy that. I hear you, right? That's what I've been experiencing too. There's not much you can do about it, right? The only thing you can do is keep an eye on stocks that have been under pressure a lot. And when the market opens, see if it looks like they're going to do it again today, right? That's pretty much all you have. But I would warn, and this is a fair warning, one of the dangers is, what if I get in later in the move? Is there really much left? Usually not. Usually by the time these stocks get to one of those targets that I mentioned, typically that's it. Or if they go any farther, it usually takes a lot longer, a lot later in the day before they do, right? So let's look at another example, okay? Let's look at Lyft, okay? This one, not quite as extreme, but similar, right? Starts today, gap down, sure, but immediately in a nosedive. Now, there was a small chance that we could have caught this one if we just saw it at the right moment. I always look for a pause in the momentum as a means to get in. When I get into the discussion about the Heikin-Ashi bars, I'll show you what I mean. That's what's coming up next. But when I look at a stock, I'm looking for momentum. You know, where you see a lot of red, then a little green, then a lot more red, a little green, or if it's going up, a lot of green, a little red, a lot more green, a little red, something that looks like it really, really, really wants to go. Okay. Okay. So with that being said, and I'm just going to go over this one and then move on. With this one, we saw a sharp decline early on. And if I happen to be watching when it started, great. If I happen not to be, I probably missed a good portion of that. This one got to the bottom and it took more time. It got to that 15% of the maximum projected range. It got there in about 18 minutes. So there was enough time to catch it if you were fast going through your stocks. So my strong recommendation right now, right? My strong recommendation right now is this. When you are looking through your stock lists, just rapidly click through them. The current market environment is moving so fast that if you don't just rapidly click through, you're not going to see the best ones. So basically, if you have to sit there and think for too long about it, just move on. So what I've been doing since today is just click, 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 click. And as soon as I see something looks like it might be okay, I mention it to the room. I say, hey, this one's on a momentum move. Here's the potential target. Check it out on your charts. Here's another one. Check it out on your charts, right? It's the only thing you can do right now. And if you're doing it by yourself, then obviously you're going to have to do the homework yourself. But basically, you're just going to have to move a lot faster, okay? And you may not be able to catch anything even if you do, all right? Now, folks, let me look at one more. Why don't I look at one more just for the record, okay? Let's look at Palantir because that has been down quite a bit recently. So let's look at that, all right? And I'm just going to do one more and then we're going to move on. All right, so this was not yesterday. This was 2 days ago. But PLTR, let me see if I can zoom in a little bit. I guess this is as much as I can zoom in. Oh, there you go. Okay, so there's Palantir. Opens here. Sharp move down. So within, let's see, 1, 2, 3, 4, 5, about 5 minutes flat. It's already hit that 75% of the maximum projected range. Then it pulls back, starts to go down again. Now, this one we did actually have a shot to get into because it did reverse for a second and then start to go back. So because it had that pause and then it starts to go down again, we get a second chance to get it. So if we couldn't catch it on the first part of the run, which practically speaking was impossible in this case, unless I literally sold it right at the open, there's no way I caught that. So the only other way to get it is after it's on the move, I wait for a setup, something that I can target that tells me where I should trigger my entry, and most importantly, where I should put my stop. Because if I get into the trade, I need to know both, right? I need to know what is the I need to know what is the target, where do I think the stock will ultimately go, and I need to know where I can try to get in, and if I get in at that point, where should I put my stop? Okay, so once I have that information, then I go on from there. Okay, and the word of the day is funder. Yes. Okay. All right. Now, folks, let's talk about some of the ways we could try to get into a trade. Now, I just told you about one potential way of doing it, which is to look for a move down in this case. Then the stock pulls back a little bit, and then it resumes this move down. So roughly where that dotted yellow line is, if you're using that approach, which I usually use, that means I'm getting in just after it crosses that yellow line. So I see the move first, then it pulls back, and then it resumes this move down. The only condition is I need to know where do I think the stock is going to go. If I think it's only going to go to this gray line, which is what I did because that was what the projection said, then I would have to ask myself, is it worth it? Because if I get in here, I got to put my stop loss up there, right where it pulled back. Remember, the pullback is where I'm looking to place the stop. It's the natural place on the chart where the market already showed how far it was willing to go in the opposite direction of the trend. So if I were to use that strategy, well, unfortunately, I wouldn't have been able to get into the trade simply because by the time I get the trigger, it's already too close to the target. Okay. So let's try it another way. Let's say we're using something else to do this. All right. What if we're using Heikin-Ashi bars? Now, it took a long time for me to know that these are actually pronounced Heikin-Ashi. I asked a Japanese friend of mine to, or actually was a member of the room, and they said that's how you pronounce it. So I always said Heikin-Ashi. He said, no, it's Heikin-Ashi. Okay. Whatever the case may be, right? Now, let's take a look here at an actual chart from today. And if I can find it, that's not it. Hold on. That's not it. Oh, it's right here in the background. Sorry. 1 second. It's right here. All right. Let's look at this chart briefly, very briefly. And I'm going to pull up Palantir, PLTR. And I'm going to turn this on to Heikin-Ashi bars. Make sure you guys can see the same thing I'm seeing. Okay, there they are. Full screen. Full screen. And let me crunch this together. Okay, there's the day in question right here. Now it's going to jump around a little bit because the market is trading, so you're going to see it bounce up and down a little bit. Sorry about that. But if you look here, this is the start of the day. So it goes off on a sell-off. Boom, 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 goes down like a rock. Then over here, you have the little pullback, and then it starts to resume its move down. Now on these bars, what I'm looking for is a momentum candle. I'm looking for the candle that's red. In the case, since I'm looking for a short, I'm looking for the candle that's going to be red. It's going to be flat at the top, no tail, no wick, no line at the top. And it's going to stretch down. The body's going to go down, and then it's going to have a little tail at the bottom. Okay. Which happens first, right where my cursor is pointing. Now, is it possible you could have taken the trade earlier? Yes. However, usually it's better to wait. Usually it's better to wait because a lot of times when it looks like it's about to turn around, the next, it does another little move up. So the momentum candle down starts right there. That means your entry would have been close to the bottom of the candle, not at the very bottom, in the lower third of it. And then your stop loss is right up here. Okay. Now, that means that I don't get in down here, but I get in up here. And that little difference allows two things to happen. Number one, it allows me to have a better reward to risk, because if I'm only projecting, it goes to this gray line. And again, I have to have some projection. I have to have something telling me how far I think the price is going to go. Yep, not Heineken, Haken. Okay, it's spelled Heikin. Heikinashi. Okay. Heikin. Okay. Now, here's the deal. Okay. With these type of bars, if you're on any software, just go here, just like I did. You can select them. Almost every software package out there has these. So you don't have to have anything special. If you have Thinkorswim, Schwab, whatever, you got them. Now, what I'm pointing out here is that once I get the signal to short, I get it sooner on this. If there's any pullback at all in the trend, I'm going to get the signal faster on this than I would in the other method I was using. That doesn't mean the other method is bad. There are times where the other method works much better. Each situation is going to be different. But when you have stocks moving very rapidly, you're probably going to get better luck using these than you would the other approach. In other words, if they're moving very fast, probably you're going to get a better chance to get in using these. I'm just showing you one potential way of using it. There's actually more than one. But this is the simplest and most straightforward way. So again, you see the green, right? You see it slow down. It doesn't even have to turn green. It could just be like red, but you see like the tails on both sides, a little doji looking, for those of you who know candlestick patterns. And then suddenly you get the momentum candle down. When you get that, that's all you need to see, right? Could you do that without these? Of course. You don't need them to do it. You can see it with your eyes for the most part. But for most of us, it's easier to spot because the system, the study is actually simplifying the picture for us to make it blatantly obvious what's happening. Sorry. So if I look here, I can still see that over here. I don't need the Heikin bars to recognize it, right? I can see this candle suddenly drop down here. That's basically the one. But if it's easier for me to spot it using the other studies, right, then I can use that. All right. Hopefully that makes sense, folks. Now, let me jump on to the next topic here. So bear with me 1 second. Where am I? Oh, sorry, I forgot. It's behind here. So let's talk a little bit about the next part, which is, let's just look at this summary here, okay? Make sure you see what these are. So that's what they're called, Heikin, Ashi candles, right? It's just a setting on a chart. All it is basically is an averaging of a price bar, okay? Now, if I look, when you see there's no upper shadow, that means you have a momentum candle, okay? You have a stronger move if there's no shadow. If there's a little bit of shadow, that means that things actually did slow down for a little bit, and then they might resume after that. So this right here, this little candle I'm circling, that was a little bit of a pause, and then it resumed down. There's another little pause, then it resumed down, okay? And of course, if it's going upwards, the same thing. No lower shadow means that you have high momentum at that time. All this is an averaging of 2 price bars. That's it. It's just averaging 2 price bars and creating one. You can look up the formula if you ever want to, if you're curious. Now, there's no crystal ball here. I want to be clear. The only way this works is if you pick a stock that actually shows strong momentum early. If you don't pick a stock that's really moving, it doesn't matter what you put on your screen. It's not going to really do much for you. You need a stock that's actually moving like the ones we've been seeing recently. When that's happening, this can be very useful. But when it's not happening and you start to apply this to a stock that's absolutely dead and going sideways and neutral, you're just going to lose money. You're going to be getting in, out, losing money because every time you buy, it comes back down. Every time you sell, it goes back up. You need there to be pressure. You need there to be, there has to be urgency in the movement, okay? And that's what we focus on in the prop room. And let me go over that really quickly here. So one of the benefits of being a proprietary trader is that you are part of a group that's focused on one goal, which is to make money, of course, but also you have rules, you have structure, okay? And you have access to capital. Now, prop trading is not for everyone, and I'll be the first one to tell you that. But I think most of you are probably somewhat interested in knowing more about it if you don't already. So let me just give you the rundown quickly, and then we're going to spin the wheel. So prop trading basically is this. I want to trade with more capital than I have now. When I started out trading myself, I started out with hundreds of dollars in 2004. And then basically I realized after a while that I had very, very little chance, right? Very, very little chance of being able to bookmap is great. Yes. Bookmap, we use that in the room every single day. It is fantastic. Yep. You are absolutely right. We use bookmap every single day. Okay. So that being said, when I look at prop trading, okay, when I got into the business, I had a simple thought. I was working in social services. I was making $10.75 an hour plus overtime. And I asked myself a simple question. Am I ever going to have enough money to be able to trade by myself? Now, I know the dream is to take a few $1,000s and turn it to hundreds of thousands of dollars. For every one person that's done that, there are a bazillion people who never did. And it's not because they were bad traders. It's just because the probability of hitting that perfectly is like getting that super 8 criteria parlay on, on a sports betting app. Like it's not likely to happen. So everyone's going to say, I knew it was going to happen. But the reality is it's all random. If you get the big, big payout, it is truly, truly just a chance that you got it. Okay. I'm just saying that I know plenty of people who've had those payouts, like those big winning trades that turned them from a 6-figure trader into a 7-figure. It happens. But what we're talking about here is taking $5,000, turning to hundreds of thousands. That's not something that you should be counting on, no matter how good your trading is. So when I thought about that in my early days, I didn't even know what prop trading was. I just decided that I need to get more capital. So I got a job working for a firm where they said, we already got the money. You just have to make the trades on behalf of the clients. Okay. Now I have a lot more money. Guess what? I make a lot more money. It was very simple. Now, you do have rules, however. If you're going to trade for any company, whether you're trading for a mutual fund, hedge fund, pension fund, prop firm, whatever, you're going to have rules. It's just the way it is. It's not going to be as wide open as your brokerage account, which basically has only rules like how much margin you got and things like that, right? What trades you have, what instruments you have access to. That's what your broker does. They make it very wide open. It's an open, canvas for you. Prop trading is going to have structure and rules. Now, the good side about that structure and rule is that the structure and the rules are set up for one purpose: to be able to make you profitable. And the reason why is because in the trading world, we have decades, generations of data on traders. A lot of people don't realize that, but I mean, me personally, I know I have tons of data to back up anything I say about what traders usually do. And what I can tell you is what most people do poorly is manage trades. So when you're in a prop environment, you're forced to learn how to do that, because if you don't, you can't advance to scale up to more capital. So in short, having access to more capital is the biggest plus. What you do with that capital afterwards, you might decide, like I did, that I'll take my money and just trade on my own for the time being. I've been doing that for the last 5 or 6 years, right? But you have to get the money first, right? So in short, it's a way to get your pay, get your money. And just like I say, think of it just like any other business. You may be working for your boss, but you're working your way up the ladder. You're getting better and better at it. And at some point you want to strike it out on your own, open your own firm, then you do so. But first, you got to get to the point where you can do that. You have to have the resources, the capital, et cetera. Okay. So in short, access to firm capital without you having to risk your own money. In other words, you get $100,000, $200,000, but you don't have to put up that as risk, right? You have profit potential much higher, because if I can make 10% on $2,000, it's going to be worth a lot more on 200,000. Scaling, meaning that as you improve your trading, you get much, much more capital. And we're not saying like just hundreds of thousands. If you're really in this, you'll be getting into the millions to possibly tens of millions of dollars as you scale, okay, as far as what you can trade. Also, you have direct market access, usually better trading platforms. Of course, the structure management of your risk is critical to learning how to succeed. And then, of course, you're going to get mentorship as well. So there are huge benefits here, right? So if any of you are looking at that, here's what I can tell you, right? If you want to look into trading for proprietary, right, we offer $250,000 funded once you qualify. How do you qualify? You start the challenge, you demonstrate you can trade on a practice account. When you get through with that, if you succeed and pass the criteria, which are always described, then you get to the $250,000 as your starting point. And then once you proceed through there, there's the next step up, right, which is to get to the even bigger money. So $250,000 is not big money in this business. That is where you start. That's your entry level buying power. But obviously, a lot can be made with successful trading with that much capital, that much buying power. Okay. So you can get funded in as little as 12 days. But if you're interested in that, just let us know, right? There should be a link. There it is. Just go ahead and ask away when you click that link, and we'll go from there. Now, it is time to spin the wheel, if I'm correct. Okay, I'm looking for the wheel. There it is. Okay. All right. So I want to spin the wheel of names. Give me 1 second. Just got to pull it up here. All right. And by the way, this was actually supposed to be, I was going to make it Vegeta, but remember, I'm going to be live tonight at 8 p.m. Vegeta is my favorite character of any cartoon character. That's why. But anyway, I'm going to be live at 8 p.m. Eastern. So I want you guys to join that, where I'm going to go over more details about the funder program. So let's spin the wheel and let's see what we got. Here we go. Let's spin it. Who's going to win? David Roberts. David, are you there? David Roberts, you are the winner. All right, awesome. All right, so can we post the link here for David to click? So you're going to get some Prosper swag, some nice Prosper swag from us. All right. Hold on for 1 second. Let me get the link. So live tonight, it's going. You should have gotten an invite for that, but oh, there it is. The link is up above. It's right there. Prosper just posted it. There it is. Thank you. Thank you. All right. All right. Awesome. Awesome. And guys, for the team, is there a link for them to get the Prosper swag? There it is. Okay. Please email us, David Roberts, sorry, at prosperswag@prospertrading.com. prosperswag@prospertrading.com. Nice swag, by the way. We got some really nice stuff. So make sure you do that. And looking forward to seeing you get that reward. Also, mostly for those of you who are going to join me tonight, looking forward to seeing you tonight at 8 p.m. Eastern time. And I'll be going over everything about prop trading. Okay. All right, folks. Other than that, have a fantastic rest of your day. Thanks again for joining us for Market Minds. Take care.